Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Aon Plc annual report. Aon Plc offers a diverse range of services to its clients worldwide. At the core of their business are commercial risk solutions, which include retail brokerage, specialty solutions, global risk consulting, captive management, and affinity programs. These services help businesses manage various types of risks. In addition to commercial risk solutions, Aon also provides health solutions such as consulting and brokerage, consumer benefit, and talent advisory services. The company's expertise in insurance-linked securities, capital raising, strategic advice, restructuring, and merger and acquisition services enables clients to navigate complex financial transactions. Aon's portfolio also includes treaty and facultative reinsurance services, which help businesses manage their insurance risks. Furthermore, the company offers risk management products and services, capital market solutions, and corporate finance advisory services to support its clients' growth and stability. The company provides investment advisory services that cater to various plan types, including defined benefit plans, defined contribution plans, and trusts for corporations, public pensions, endowments, and foundations. This comprehensive range of services makes Aon a one-stop shop for businesses seeking risk management and human capital solutions. Aon plc's stock price has experienced a significant drop in the past year, with a decline of over -17.4% by February 9, 2026. Several news events have contributed to this downturn. One major factor is the mixed fourth quarter 2025 earnings report released on January 30, 2026. While Aon's adjusted earnings per share, EPS, exceeded expectations, its revenue fell short of anticipated levels. This discrepancy created uncertainty among investors. Another significant contributor to the stock price drop is the fear of AI disruption in the insurance sector. Around February 13, 2026, concerns over AI innovation significantly impacted Aon's stock, with reports of Insurify launching an AI-driven insurance comparison tool and OpenAI approving its first AI insurance application, leading to a sharp decline. Additionally, Aon plc's stock hit a new 52-week low on February 9, 2026, trading as low as $309.13 the following day. This milestone signaled a significant downturn and likely fueled further selling. Lastly, broader market weakness and macroeconomic factors also played a role in the decline of Aon plc's stock price. Investors were rotating away from certain sectors, and the company's substantial consolidated debt load was highlighted as a risk factor. Aon plc market capitalization of $69 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Aon plc holds a significant advantage in their industry. Aon plc trades at a higher price-to-earnings ratio of 19 times and a higher price-to-book ratio of 7.38 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 87% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for a given company can be attributed to several key factors. One major contributor to revenue growth is the expansion into new geographic regions, including the United States, the United Kingdom, Canada, Singapore, and other foreign countries. This strategic move has enabled the company to tap into new markets and increase its customer base. Another significant driver of revenue growth is the risk capital segment, which has experienced notable increases in insurance commissions and fees for services rendered. The human capital segment has also seen substantial growth, driven by increases in consulting services and talent advisory services. Furthermore, the company's acquisition strategy has contributed to revenue growth, as it has expanded its offerings and capabilities through strategic purchases. In addition to these drivers of growth, the company generates revenue from various streams, including insurance commissions, fees for services rendered, consulting services, talent advisory services, and fiduciary investment income. However, despite these growth drivers, the company has experienced some decline in revenue in certain areas, such as the Reinsurance Solutions (RS) segment and the Data and Analytical Services (DAS) segment. Overall, the primary drivers of revenue growth or decline for this company are complex and multifaceted, involving various business segments, geographic regions, and revenue streams. The net income and profit margins of Aon have undergone significant changes over the past few years. In 2023, the company's net income was $2,628 billion, which decreased to $2,720 billion in 2024. However, in 2025, the net income increased by 38% to $3,750 billion. The operating margin also improved from 23.9% in 2023 to 24.4% in 2024, and further to 25.3% in 2025. The increase in net income can be attributed to various factors, including changes in revenue, expenses, and operating efficiency. Additionally, the company's profit margins were improved due to increased pension contributions and reduced accelerating Aon United program expenses. However, there were some exceptions, such as a decrease in net income in the UK and US regions. Overall, the net income of Aon has shown an upward trend from 2023 to 2025, with a significant increase of $1.2 billion. The operating margin also improved during this period, indicating that the company's profitability has increased. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the latest data, the company has achieved positive operating cash flow, marking a notable milestone in its financial journey. In 2025, the company generated an impressive $3.5 billion in cash flows provided by operating activities, page 29. This substantial amount is further reinforced by the operating cash flow figure of $3,481 million reported on page 63 for the same year. These numbers demonstrate a clear trend towards financial stability and growth. The positive operating cash flow is a testament to the company's efficient management of its resources and operations. It suggests that the company is capable of generating sufficient cash from its core activities to meet its financial obligations, invest in growth initiatives, and reward shareholders. This achievement is likely to have a positive impact on the company's overall financial health and future prospects. The performance summary for various segments and regions reveals a mixed picture. On the positive side, Commercial Risk Solutions, Reinsurance Solutions, Health Solutions, US, and UK all performed well in 2025, with significant increases in revenue compared to the previous year. These segments saw substantial growth, with Commercial Risk Solutions experiencing a notable increase of $636 million in revenue, while Reinsurance Solutions and Health Solutions also reported impressive gains. The US and UK regions also demonstrated strong performance, with revenue increases of over $600 million and $245 million respectively. However, not all segments fared as well. Wealth Solutions, Americas other than US, and Ireland performed poorly in 2025, with significant declines in revenue compared to the previous year. These regions saw a decrease in revenue, indicating areas that require attention and improvement. Management's outlook on the company's strategy is centered around innovation, expansion, and partnership building. They highlight strong growth across various segments, including organic revenue growth and restructuring savings. The company's balance sheet and cash flow are considered adequate to meet its needs, with a focus on generating annualized expense savings of approximately $450 million by 2027. Management expects to incur higher costs due to program actions, but believes that cash generated by operations will be sufficient to service debt, finance capital expenditures, and pay dividends. They also intend to limit distributions from foreign subsidiaries and repatriations from certain jurisdictions to minimize tax liabilities. The company's investment policy seeks reasonable asset growth at prudent risk levels, with a focus on contributing to its significant pension plans. Management is accelerating their Aon United strategy through growth in risk capital and human capital, aiming to maximize value for the company and its shareholders. Overall, management is optimistic about the company's prospects, citing strong growth and a solid financial position as key drivers of success. The company's financial activities have been focused on rewarding its shareholders through various means. One such way is by paying dividends, which has been a consistent practice as evident from the payment of quarterly cash dividends and annual dividend payments to shareholders. In fact, in 2025 alone, the company paid out $490 million as dividends. In addition to paying dividends, the company has also taken steps to return value to its shareholders through share buybacks. A significant portion of its shares have been repurchased at an aggregate cost of approximately $26.2 billion. This move is aimed at reducing the number of outstanding shares and thereby increasing the earnings per share for existing investors. Overall, it can be seen that the company has made a concerted effort to reward its shareholders through both dividend payments and share buybacks. There is currently no cause for concern regarding inventory buildup or supply chain disruptions. This suggests that the current state of inventory and supply chains is stable and functioning as intended, with no significant issues arising from excess stockpiling or disruptions in the flow of goods. That concludes the financial summary for Aon Plc. Feel free to comment below, and I will be happy to answer them when possible.